Hey there, everybody. Welcome back to another 21st Century Renaissance and another open interest newsletter breakdown on GameStop. I'm your host, Dr. Michael LoPiano, and today we are going to be continuing our conversation about what may be some motivation for institutions to clear outstanding obligations. We'll be thinking about that as well as what its influence may be on our price action going forward in the immediate future, as well as what we might be expecting from these three crucial dates we've been talking about coming up over the next 4 weeks. So that's coming up today. Before we get started here, we will turn our attention to our gratitude as we do on a regular basis. Today's gratitude, once again, goes out to Prince Jackson for sponsoring today's article and video breakdown, as well as to our monthly supporters, Not Medical Advice, Master Kurt Lusko, Cosmotropic to Swag52, and Hey Luckies, aka Faithless Looter, for helping offset some of my data and publication expenses on a regular basis. And I also wanted to go ahead and do one more pointed shout out to a group of folks who went ahead and offered some support, bought me quite a few copies as part of a gift for my recent wedding over the past couple weeks. So many thanks go out to Beckett B. Grand, aka Dude McStud, Master, Gimpy Guido, Who Loves Avocados, Mr. Skint, Samuel Bowser, Maxi King, aka Beep Boop, and Jimmy Perp. So thank you guys very much for your gift on the occasion of my wedding. Very excited as well, right? Everybody who went ahead and sent wishes, everybody who said prayers, many thanks for the return of my father to good health was successful. So thank you very much to everyone there. Thank you very much for everyone who has continued to leave questions, comments, for the warm welcome back after this 2-week hiatus, thereabouts close to 2-week hiatus. And yeah, I'm very excited to see all of you as we continue to think about some of these recent developments in GameStop and what we can expect going forward as we get back to our regular schedule right this week, including back to our regular live stream schedule. We will be seeing each other on Friday at 4 p.m. Eastern time. So certainly feel free to pop over there, for a little while, for a long while. Just come, have ready to pose questions, have a good discussion, and have a good time as always. So yeah, so let's get into this today, right? Think about this as a potential moment for what we might say is the turn of the tide. Use this Gandalf meme today. And this is pertinent and sort of continuing along with our discussion. In yesterday's video, I did go ahead and outline some of the points and tie together some of the points that I started to discuss yesterday, particularly regarding what we might expect over the next 4 weeks as pertains to rate cuts and possible obligation settlement. In the article, if you'd like to see that laid out, certainly go ahead and check that out over on Twitter, of course, linked in the description of this video. But let's break some of this down, right? And what I might say, I will say that in thinking about my own trade decisions, my own strategies for managing my investment in GameStop, full disclosure, none of this, of course, is trade advice or investment advice. I'm not a professional. I'm not a licensed financial advisor or anything like that. But I do have, right, my sole investment in terms of finances is in GameStop. So yeah, I've been working on this for over a year, right? Posting about this daily during trading days for the past 14 months. So this is my perspective and why I am particularly interested on the stock. Maybe some of you are new to the channel, but I'm going to be building a case here for why I think we may be entering into a key moment for institutions, kind of a last hurrah for institutions if they do have internalized obligations going back to the convertible bond offering, the second one in June of this past year, why this may be, and by this, I mean these next 8 days going into August OPEX, a potential for a return for some upward volatility as they have their last opportunity to, let's say, in a low risk environment, clear out some of their obligations. So let's talk about that. I will point out, right, we do have these, the first point I should say in thinking about this pertains to these next 3 coming key dates, which you can see here on your screen, right? So August 15th is OPEX. But in addition to OPEX, it is the 13F filing deadline for institutions. Those deadlines do fall 45 calendar days following the conclusion of the last fiscal year quarter. So Q2 fiscal year 2025 quarter 2 ended on June 30th. So August 15th is our filing deadline. Why is that important, right? Why is it important to think about 13F filings? What does that tell us? Well, historically, with respect to GameStop, when we have seen increased institutional ownership, I mean, if you think about major stocks in general that tend to kind of go perma up, we see that a majority of these stocks, a majority of the ownership of these stocks is in institutional hands. That was certainly true of GameStop going back to 2020. So going into the major price volatility event of 2020, many of the events in 2020, and sort of culminating in June of 2021, about 75% of GameStop's outstanding shares were in the hands of institutions. This changed in June of 2021. As we can see, institutions cut their holdings by about 65 to 75% following that last kind of rainbow road spike in 2021. And then we went into sort of a major period of bearish price action for the better part of almost 3 years. And over that time period, right, we didn't really see institutional ownership change very much at all. We did see, for example, right, if you look at this chart, it does look like it popped up in December 2022. That was largely just the effect of the stock split, the 4-to-1 stock split taking effect. So it looks like that 75% reversed, except that, no, that was just number of shares ending back in institutional hands. The outstanding number of shares outstanding increased significantly as a result. So not too much change in institutional ownership. It did go up a little bit versus December 22 throughout 2023 and early 2024, but really not too noticeable. It did see its first notable spike up following the price action events of May and June of last year. However, the real kicker was in December of last year, November and December, following the November 15th filing deadline, and of course the first 2 of 3 rate cuts that occurred late last year, which has sent GME institutional ownership on this accumulatory trajectory. So we can see, right, last quarter, GME institutional ownership increased by about increased to about 50%, I should say, of its 2020 and early 2021 levels. So not quite to the level we saw in 2020 and 2021, but it's getting back there, right? And so the idea, right, the theory behind this is that, okay, institutions, major institutions, will, let's say, not allow a ticker, a stock, a company, a publicly traded company to begin to appreciate until they themselves have properly sorted out their positioning such that they can take maximal advantage of that stock's price appreciation. So our theory, you'll remember this, of course, not just mine, but certainly one we've discussed here going back into June, late June, and then through much of July, that GameStop has been essentially in this accumulatory pattern that going into what is likely going to be a profitable Q2, certainly not only just profitable for the company, but operationally profitable, Q2, Q3, Q4. Our next 3 quarters are set to be very good, right? We are looking at a major console cycle. This has historically meant a significantly increased revenue for GME. This was certainly the case in 2020, right? So GameStop going into Q4 of 2020 was going into a major console cycle. So, right, if we take a look, we can see, right, with this theory, the idea is institutions will likely have used this late June and then possibly down the road, right, once we take a look at, once we get Q3 13Fs in mid-November, the theory there is that institutions will have significantly upped their positions. Institutional ownership will expand. So I think we'll probably see the more drastic, we'll see. I think maybe the more drastic one we'll see will be revealed down the road in November. But as we can see, we do have our sort of the first whispers here, the first inklings that institutions are starting to build very large positions. So We did get an early filing yesterday. The Bank of Montreal went ahead and revealed a position of over 2 million shares, an increased position of 2.13 million shares of GameStop were picked up. So that's a 16x multiple on the size of their position, worth over $50 million at present. And yeah, that's good for a 0.5 percentage point increase. Just this position alone on institutional ownership for GameStop. So obviously we've got about 10 more days here before the filing deadline comes along. But yeah, we can expect within this range. I would say more filings like this, but very cool to see a large institution, Bank of Montreal, a decent sized institution, go ahead and post a position size increase, right? Of that magnitude. That's certainly what we're looking for, I think, in terms of estimating whether we're going to go into maybe a macro bull cycle of some duration. So good to see that. Yeah, we'll also notice, right, of course, another factor that lends itself to this idea that institutions have some pressure to go ahead and build out their positions now, aside from the fact that GameStop is trading and just recently traded very close to the 2x cash floor. So 21.93 is what I calculated a while back as the 2x cash floor following the second convertible bond offering. We hit as a low 21.92, so basically within a penny of that estimate. The hard time imagining GameStop right get much below that, as that requires you to essentially well, it's a very conservative valuation. I'll say that much. But another element that plays into this has to do with rate cuts, right? So if we take a look back, into the fall of last year, September, November, and December, we got 3 rate cuts, a 50 basis point rate cut, and then 225 rate cuts on September 18th, November 7th, excuse me, and December, I think also December 18th. So these 3 rate cuts were followed within 2 days by substantially bullish price action, huge volume, and then a bull trend lasting quite a large period of time. And then of course, especially following the first one, right, GameStop has never returned to the prices seen prior to that first rate cut, that first 50 basis point rate cut, in large part due to the acquisition, the completion of an at-the-market offering, right? It was hanging out there. Everyone was really confused, right? I myself was confused about this. We talked about this. It's very strange. It was like, hey, why, we had this good Q2. We had these massive offerings. Wait, why go with this little guy? Why do this 20 million share offering picking up 400 mil? Like, that's bizarre, right? Why do that and then have the price crushed all the way back down to 1930? That's kind of bizarre. And then, of course, the other offerings back in May and June were bought instantly. We had to wait something like 8 or 9 trading days before we had any news about whether the at-the-market offering in September was going to be completed. And then sure enough, we got our rate cut. We had 1 day following the rate cut news. And then that Friday, we just went off on this tear and then shot up basically almost all the way back up over the next, I think, 7 trading days. Not quite to the pre-Q2 earnings high there, up around $25, but very close. So, the idea is taking a look at FedWatch, right? A couple things. We'll come back to this little post here in a second. But as we take a look at FedWatch, right, we talked about this live, I suppose live. I noticed this live while filming yesterday's video. We have very, very high odds estimated for a rate cut September 17th. Early in the year, Fed was certainly giving forward guidance suggesting that at least 3 rate cuts were coming, maybe a 4th, but at least 3. With the conclusion of the July period without a rate cut announced, this by and large says, okay, well, there are only 3 potential moments for rate cuts left. Fed continues to say they're not pivoting on current goals and policy. Potentially jobs data looked good to cause this. I'm not really sure. Stated reasons often differ from the true reasons why these decisions are made in the first place. But in any case, FedWatch is basically estimating the probability of a 25 basis point rate cut on September 17th is at 87%. It was actually over 90% when we took a look yesterday. So if we get 1, 2, 3 of these kind of going into the fall, together with another strong earnings report for GameStop, which suggests, right, an important element of that is GameStop's partnership with PSA and the development of the trading card market. We are going to talk more about. We're going to revisit this model. What has now been revealed to be the push start arcade model that we talked about way back, during the Thailand days, during the post Q4 earnings report days. We had a couple live streams and a couple videos where we broke some of this down. We're going to revisit this Friday, so certainly tune in if you want to talk about sort of my views of why I think the push start arcade model is going to be extremely successful, and what it means, and why we are going to start seeing, why we're seeing these news reports about, say, TCG Pokemon cards coming out, why we're starting to see these kind of work their way into the mainstream. And part of it is, this is the unveiling. This is, I think, I read this right now. Hindsight, of course, will be the clear determinant. But I see this, right, of course, as we're seeing the pillars of success that GameStop has been adopting sort of work their way into the mainstream. This is already, right, this is already known. Those of us that have been following the stonk, right, we know what the bullish thesis is. But of course, the bullish thesis can't be allowed to actually play out until major institutions themselves stand to gain from it, right? This famous clip that we see memed all the time from The Big Short about the short itself on the housing market wasn't allowed to be priced accurately until major institutions had secured a net short position themselves. So the inverse can be assumed here for GameStop in equal measure. So what we're starting to see here, and this is an important sign, when we see the GameStop narrative, when we see the fundamentals of GameStop success that all of us have been watching for, waiting for, that we've been tracking. I mean, this is almost like, really, for those of us that know, for those of us that have been tracking this, this has been moving in slow motion. It feels to us, right? But for the mainstream that gets told, GameStop's a meme stock, be afraid of it. This is a weird thing. This is a weird Reddit thing. Go somewhere else. To see, say, now Pokemon cards and TCG and this sort of thing work its way into these carefully placed media narratives over in, let's say, boomer space, into a normie land of the S&P 500, this bodes well, right? This bodes well for GameStop, because these are the seeds, these are the breadcrumbs, these are the bricks being placed for down the road when GameStop really starts to move. They can say, well, we told you so. We did our job, right? As the media, we informed you. This is a way for them to then eventually stir up interest and acceptance that, well, yes, of course, it was really the trading card thing that made the turnaround, or some of these more fundamental things, and the market is really fully intact. You don't need to worry about all this derivative stuff, settlement obligations. No, don't worry about any of that stuff. Really, the fundamentals. Ryan Cohen, he turned it around, really, right? And Ryan Cohen did do these things. This isn't that I'm saying this isn't true. But of course, right, it's to really make sure that narrative is well established, and that things are in their place. But that certainly bodes well down the line for appreciation of GameStop's price action. Certainly, as we head into this major revenue cycle for the company. But speaking of obligations, right, let's take a second and also reflect on this, right? So part of the claim that I made earlier here is that I think this offers an opportunity for some price appreciation, the return of a bit of volatility into the underlying, certainly with respect, or I should say not with respect to, but on the heels of maybe some internalized obligations and settlement obligations, and the clearing of those obligations, right? So it is, we've explored various times in the past the influence that say, looking at data in ETFs, looking at FTDs, looking at, say, cat errors, and trying to understand, okay, what's going on there, right? And we can look at that and we can say, okay, things are going on under the hood. We can look at that and say, okay, institutions are juggling their obligations. They're exploiting the dynamics of this perfectly legal in some respects, right? I mean, it's kind of built into the rules. Sort of loopholes about essentially never closing losing trades until way down the line it's advantageous for an institution to do so. That we've talked about this, and we've also talked about how difficult it is to then go ahead and predict, when we see that activity happening, how that's actually going to have an effect on the price action of the underlying stocks involved. So GameStop in particular in this case. Now we can see that very recently we're seeing a lot of activity take place in some of the favored ETF liquidity engines that allows institutions to go ahead and juggle around their obligations for settling, say, less than favorable GME trades. In particular, most recently, there was quite a lot of volume and quite a lot of fails that were connected to GameStop and to GameStop holding ETFs dating back to the second convertible bond offering. So, for example, if we take a look at XRT, a very popular, we talked about this a lot on the channel. Certainly others have as well, in a number of different cases. So the infamous XRT, of course, 613, which was the day following the day of the convertible bond, right? No, the day following the convertible bond offering, over 1 million fails. At the same time, over on GMEU, which is this new, as of late April of this year, GMEU, the 2x leveraged T-Rex, that is Tuttle Brothers, Tuttle Capital Management, I should say, 2x leverage GME ETF, single stock ETF, right? Of course, on these 2 days, on the 12th and the 13th, had over 1 million shares, over 1 million fails each day, culminating in over 1.5 million fails. So GME ETFs going back to the 12th and the 13th had huge numbers of fails. There have been some since then, but not quite of that magnitude. But okay, why are we talking about these fails? What does this mean? Well, if we go back to the tried and true, right? So the Bruneau formula, the Mendel University paper talking about the formula for understanding when ETF fails to deliver are due. So the formula is T plus 6, right? Yes, T plus 6 followed by 35 calendar days, followed by T plus 1 in the event of an equity. Something like GameStop itself, a failing GameStop itself would then have a T plus 1. For an ETF, there is a T plus 4 creation window by DTCC rules. So this can be simplified to T plus 33. Richard Newton has especially talked about this quite a lot. Certainly go check out his videos if you hadn't had the chance to do so. But right, thinking about this, we are approaching, essentially, we are in the midst of ETF deadlines here. Now, okay, we've been in this situation before. We've been at the edge of these windows with high numbers of fails, and things really haven't happened. So why are we talking about this now? Why are we back to this? Why would I be of the opinion that we're going into a context where we may see some more of this? Why it might make a difference this time? Why I'm on the lookout for this? And that has to do with these three aforementioned dates. Okay, so back before, if you look back, say, to June, right? What did we have coming up in June? If there was sort of low probability of a rate cut, earnings was already out of the way, let's say, and then we had a convertible bond offering sort of smooth things over. So we had a major pricing down of the stock as the stock was going into a down cycle. Okay, but this time, right, as we approach this, we see on our horizon, we have 13F filing deadline coming up together with August OPEX. And then following that, September 9th, we've got what is expected to be a pretty bullish earnings event. And then following that, then we've got what seems to be a very high probability rate cut at the end of September. And all of these are spaced out by 3 and then 2 weeks. So is that 2 weeks? Not even 2 weeks for the rate cut. So we have some major events that suggest a decent sized price up may be coming right down over about the next month, beginning with the 15th and say going to the end of September. To say nothing, of course, of the fact that we're going to get more institutional filings on November 15th. We're going to 15th or 16th. We're going to have another bullish earnings report likely in Q3, and then who knows, March. So all of these events, and then who knows, of course, as well for rate cuts. So are we going to get another rate cut in on October 31st? Are we going to get another rate cut on December 19th, I think it is, or December 16th? Very possible. If that's the case, if you just have bullish event followed by bullish event followed by bullish event, accumulation, and you're an institution that needs to go ahead and clear out obligations dating back to the 12th or the 13th, you have a choice to make, right? You can go ahead, push these off into another ETF, and then hope that 33 days, 33 trading days down the road, T plus 6 plus 35 calendar days plus 4 down the road, GameStop's price is going to be better, in the sense lower or more favorable to you. But right now, GameStop is already trading very close to its 2x cash floor. Maybe you get another chance following August OPEX, maybe around the 20th or something. We can get another local low. But it already does look like institutions are moving some pieces around to try to deal with some of these some of these obligations. And we can see, of course, taking a look, say, at the number of outstanding shares on XRT. So XRT, as of yesterday, had no shares available to borrow, according to data from Interactive Brokers. And its outstanding has been low for several days, including last Friday, which was exactly T plus 33 trading days from that day of heavy fails back on the 13th, wherein we saw the number of outstanding shares on XRT go down to 1.85 million. That is the second lowest total since 2007. The lowest total was back on May 1st when it hit 1.75 million shares. So just to give you an idea about price action around that, if we go ahead and look at the chart, we do see some kind of similar movement surrounding these events. So a conspicuous number of red days where we kind of just shoot down, and then a little bit of bullish recovery thereafter. So it doesn't quite align exactly when we got the day, but we do see now that XRT has gone on the Reg Show threshold securities list. So that would have been right around when we started this dump here, going into the end of July. So, of course, those of you that know the regulation show SHO threshold securities list restricts this period rate fails on the settlement of fails and sets it to 13 trading days, I believe. So it makes it a bit difficult to kind of juice a particular ETF for liquidity. Now, there are other GME holding or cash in lieu of securities eligible ETFs that can be mulcted for some of this extended synthetic liquidity. So I don't think this would necessarily cause some kind of super critical event. Not an emergency for the institutions doing this, but as the price goes up in GameStop, then the advantage to, say, delaying the settlement of obligations becomes riskier and riskier, and may possibly complicate and cause liquidity problems down the road, especially if you've got major institutions that are going to accumulate and will have been accumulating for some time. By the time maybe you get to next year, and then you get a price down as far as, say, the rolling of a swap or something like that, it gets risky, is my point. It gets complicated, and I could see within this window, as I think we are starting to see, since we do have a little bit of bullishness in the underlying, we could go ahead and see institutions clear out some of these obligations. This can translate into buying externality, right? So this is volume that comes onto the tape, doesn't get processed necessarily in dark pools, comes onto the tape, juices up some volatility, and then causes a lit market price up in the underlying. So very interesting. We do have, in terms of our options, right, we have a huge and very dense cluster of call OI, basically between 23 and 25. So in terms of how that's going to affect our price action here, as we saw yesterday, right, so we kind of bounced off that 23 level. We didn't have enough sustained buying volume to really carry us over from some sort of external sense. It has looked like we've seen some VWAP orders come in, volume weighted average price orders come in sort of early in the trading day and carry us up. What I would say is, if we continue to see that type of event, then we would very likely, I could see us move into this bracket, and then this bracket, rather than serving as a sort of resistance or a point for us to inflect to the downside, then becomes textured as something of a sticking point. So then we become sort of mired in this area, and then hedging decreases volatility with respect to sort of normal options moves. Obviously, if we have more externalized, or I should say internalized, de-internalization fed buying volume occurs, that of course can serve as a volatility churn there. And we do have a very high concentration of gamma, call gamma at these strikes. Um, Over in SPY, usually that has the effect of suppressing volatility. But in GameStop, because GameStop's volatility with respect to upward price action behaves to the inverse, this would serve as something of an options price up event, which could cause traders to go ahead and close out short calls to get pushed out of these short positions, short volatility positions, which would then cause buying and sort of closing of shorts, short hedges on the part of, say, the options market maker. It could stir up some interesting volume. Now, I would be surprised to see us move above that 25 level, but seeing a move, say, like we've seen a couple times over the past 6 weeks, where we go, say, up that 23 ladder, up to almost kind of kissing 25. I could see something like that occurring over the next few days. With certainly, the closer we get to this week's expiry, the more this gamma environment is going to get sensitive, and the greater the swings, the greater the volatility of the change in the valuation of options contracts will be. So certainly very interesting to keep an eye on. I, of course, am staying cautious, keeping my eye on this. I've significantly walked back a lot of my short volatility positions, really shrunk these positions by about 80%. Across my portfolios. So that's sort of how I'm positioning myself in the face of this, right? Just so you know, I'm not just coming out here and tossing out words, but I actually I actually act on my own analysis. So yeah, right. That's what I'm looking at today. I know this was we talked about a lot of these elements yesterday, but here we have something of a where do I want to go here? Not this. Yeah, that's what I want. Yeah, so we talked about a lot of this yesterday, but of course, we go into a little bit deeper depth here today, and break this down as I've had a bit more time to delve into this, as well as offer a few more data points. So that's continues to be my outlook going into the end of this week, and sort of going into August OPEX, and basically what I'm looking for, and what I'm paying attention to as we head into September OPEX, which is the September OPEX period right around the corner. We can talk, of course, more about this on Friday's live stream. I'll certainly see you all tomorrow for another open interest newsletter breakdown. I want to thank you all once again for all your best wishes, for all your prayers, and for watching and listening. It's great to be back, and I'm looking forward already to seeing you all tomorrow and at this Friday's live stream. So take care, everyone. We'll see you next time.